is with immense pleasure that I welcome all our esteemed paper presenters, chairs, discussants, and all the participants to session 3B on culture of equity and long-term investment by households. This session will be chaired by Vidhu Shekar sir, and we have Mr. M. Krishnamoorthy as the discussant. Vidhu Shekar sir, CFA, CIPM, is the country head for CFA Institute in India. He is responsible for advancing the mission of CFA Institute and supporting CFA charter holders in India. Mr. Shekar is an investment professional for 35 years of industry experience in India and abroad. Previously, he was Vice President, New Products and Business Excellence, National Stock Exchange of India, overseeing new product initiatives in debt and equity markets. During his time at NSE, Mr. Shekar contributed to the development of Indian financial markets through his participation in the work of various committees, including the Dr. Patel Committee on Corporate Bonds and Securitization and the Raghuram Rajan Committee on Financial Sector Reform. Prior to NSE, Mr. Shekar served as Senior Vice President at IDBI Capital Markets and MD at E-Trade Systems India Private Limited. Mr. Shekar completed his PG Diploma in Management from Indian Institute of Management, Ahmedabad in 1997.
1987.
In 1987 and holds a bachelor's degree in physics honors from the University of Delhi. Mr. Shekar is currently a member of SEBI's Primary Market Advisory Committee, PMAC. Shri M. Krishnamoorthy, an officer of Securities and Exchange Board of India, joined NISM as a member of faculty in September 2017. He is currently the program director for School of Corporate Governance. This school is playing a pioneer role in professionalization of corporate governance and capacity of building securities market participants through workshops, conferences, and publication of research papers. He is also the program director for the NISM long-term program, Data Science for Financial Markets. He is currently teaching microeconomics, securities market regulations, business ethics, and corporate governance at NISM. Apart from the above, he has been taking sessions in the various training programs being conducted by NISM for regulators, government officials, market intermediaries, and listed companies from India and outside. Shri Krishnamoorthy has been working with SEBI for the last 18 years in different departments of SEBI, including the Integrated Surveillance Department, Research Department, Corporate Finance Department, Market Intermediaries, Regulation and Supervision Department, Officer of Chairman and Bangalore Office of SEBI. Prior to joining SEBI, Shri Krishnamoorthy was working with Ministry of Law, Justice and Company Affairs, Government of India for nearly 6 years. So before we begin the session, I'll throw some light on the guidelines. So the participants will be given a total of 15 minutes for paper presentation, upon which you will hear a bell. Post that, you will be given 2 minutes for concluding your paper. After that, 7 to 8 minutes of discussion remarks, and then 5 minutes for question answers. Now, I would like the chair to carry forward the session so that we will start with the paper presentation. And so we could ask the physical presenters to begin with.
Thank you, Kush.
Thank you.
So wonderful. So this is the last session of a very long day. So it may be, but we have 3 very interesting papers today. The titles are like this. First one is the impact of mandatory CSR on firm financial and sustainability performances, evidence from India. The second one is, does CO2 emissions impact cross-border mergers and acquisition decisions, evidence from India again. And the third one is idiosyncratic volatility and cross-sectional stock returns across ownership categories. So we are going to start with the third one, the idiosyncratic volatility and cross-sectional stock returns across ownership categories. Over to you, Saumita Roy, IFHE Hyderabad.
Thank you.
Same one.
So good evening, one and all present here. I am Saumita Roy. I have just completed my PhD in the month of August 2021. I'm now working as assistant professor in IFH University in the school. So this is part of my thesis work, which I'm trying to present today. Thank you first of all, thank you for the opportunity given to me by the conference committee to present my work. So the title of the paper is Idiosyncratic Volatility and Cross-Sectional Stock Returns Across Ownership Categories. So in this paper, we are talking about idiosyncratic volatility as the name suggests. So risk is everywhere in every step that we take in the market. According to your asset pricing theories, we can just segregate risk into two parts. One is systematic and another one is unsystematic. So the systematic part we are not talking about here. We are talking about the individual firm-specific risk, which ideally can be diversified. So your traditional capital asset pricing theory says that idiosyncratic volatility or firm-specific volatility does not have a role to play in return predictability power, because it's only the market volatility which should have the power to predict return for future or explain return variability. But as in when we move forward with the research fraternity, we have seen Farmer Friends 3-factor coming in, giving us other variables which can explain like size, your value, your momentum. We can go ahead till 6-factor or 5-factor models. And then another part of theory, Merton says through his ICAPM theory, says that the idiosyncratic volatility should not have a return predicting power only when the investors are diversified optimally. They hold a diversified portfolio which is not practical in the market. So if investors are exposed to higher firm-specific risk, they should receive higher return. So there should be a positive relationship between your idiosyncratic volatility and stock returns after diversification as well, because there is no optimal diversification, quote unquote, in the market, right? But the puzzle comes in when Ang et al. In a very, very influential paper published in Journal of Finance says that in a cross-sectional analysis from 1963 to 2000, that amount data on US database, they found out a negative relationship between idiosyncratic volatility and stock return. That means high IVOL will contribute to low expected cross-sectional return. So that postulated idiosyncratic volatility puzzle. So starting from a no impact, we move to positive and then theoretically positive, and then your data says there is a negative impact. Now, why idiosyncratic volatility? The question is, so this topic has received attention from 2006, and to be very, very precise, till 2020, there are more than 1,500 papers published on idiosyncratic volatility and various aspects of it. Still, it is important only between 2020 to 2022, we have more than 200 papers on this paper, because this is firm specific. And because it is firm specific, it is also specific to the environment that is working on. There are nuances of market and characteristics of firms that determines how it happens for different markets. So in US itself, there is a debate that whether it is positive or negative. From 1963 to till 2019, we have evidences on both positive and negative aspect. So hence, idiosyncratic, empirical analysis on the return predictive power of IVOL still matters. First of all, that. And why it is important for India, as I said, because it is firm specific, hence it is country specific as well. Right? So if we need to understand what is the impact of IVOL and how it has been doing cross-sectionally over the years, we have to understand how it is impacting all the firms operating in the market. We find a gap in terms of research papers, which is talking about relationship between IVOL and cross-sectional stock returns in terms of India. And there were two papers, as per best of my knowledge, which kind of did an analysis, but they were restricted to some firms like 500 or top 100 or something like that. In our, this is my part of my research work, we tried to kind of consider the entire universe, which is more than 5,000 firms, and try to understand the impact of IVOL. So when we talk about the literature review of IVOL, we kind of divided the entire literature into two parts. One, in where we have so many papers where they have diverse evidence on positive, negative, even non-significant impact of IVL. Wherein, so one hand you have Ang et al. They have come across with 30 nations analysis and says there is a negative impact. On the other hand, you have very influential paper by Fu in 2009. He says there is a positive impact using the same data. So your just mere change in econometrical method gave them different results. So there is this puzzle. So that's the first category of the literature. The second category talks about the sources of such, variations. Why? What are the reasons? What are the firm specific reasons? Whether it is liquidity, whether it is, your volume, whether it is your earnings management, whether your product market competition, and various other aspects which can contribute to such results. So we are for now concentrating on the first part of the literature wherein we're trying to understand what happens. So these three papers I've highlighted for us to understand and not invest much time over here, as we spoken about. Ang et al. Shows negative, Fu shows positive, and I've highlighted one paper for Indian aspects. This is the first paper by Kumari et al. They have considered 513 non-financial firms for this analysis, and they have found out a positive impact of IVL on cross-sectional returns. I'm going on a very basic overview basis because of the time. So the gap is that when we are talking about market-wide volatility, 513 firms or a restricted group of firms does not do justice. So we consider all the firms operating in the market that's more than 5,000 firms and put a filter criteria wherein we can, just delete those data wherein we do not have trading price data at least for 15 days for a month, because we use daily data for calculating IVL. So, and also for India, the ownership structure, most of the firms can be categorized under either business group oriented firms and a standalone firm. So there are firms which kind of operate under one business group, and there are firms which operate standalone. Because we're talking about firm specific natures, we wanted to just divide firms under these two groups and see whether the impact of IVL changes if we do so, right? So these are two gaps which leads us to two objectives, very precise objectives to examine the impact of IVL on cross-sectional stock return for the entire country, for the market, for between 2000 to 2019, so 20 years data, and then understanding the impact of any type of ownership, if we just divided it between BG and SA for say, whether it is changing or not. So with that, we've formulating the hypothesis. H1 talks about the impact of IVL. We have kept it open for the sole reason that we have evidence from both the sides and also from the non-significant side. So we wanted to check, let the data speak what is the real scenario in India. So we kept the hypothesis open and for in any direction for to say. And we also hypothesized for two segments of idiosyncratic volatility. With two type of difference. One is in level difference, that means the percentage wise level difference between BG and SA, and the impact wise. So idiosyncratic volatility could be high or low for BG and SA, and the impact of IVL on return could be either positive or negative or non-significant for both BG and SA. So that's why we have H2 and H2B to differentiate between ownership structures. So this is the estimation procedure. I take the follow Ang et al. And update the model. Ang et al. Uses 3-factor model. I use 4-factor model. Calculate idiosyncratic volatility using daily return from the epsilon, which is the standard error, the standard deviation of the error for individual firm for each month. We regress this asset pricing factor model and calculate your epsilon. This is my idiosyncratic volatility, which is unconditional. Then there are papers who argue that volatility has time series impact. So we should be using a Garch model to encompass the time series impact of volatility. So we also calculate idiosyncratic volatility, which is the conditional. So we now on say CIVL and UCIVL for unconditional and conditional. We use eGarch model. For each firm in our sample, we use 9 type of models for every month for every company, find out the AIC criteria and use the AIC criteria to choose the correct eGarch model for individual firm. So we have 2 measures of idiosyncratic volatility, and these are the other measures which are the control variable for the regression equation. So my size, which is a part of my 3-factor, Book to market value, my value, part of 3-factor. Momentum is part of 4-factor. And beta is also our kappa and business group, which is BGNS. So data source, we collect the daily data from CMI ProS for all the stocks traded in the market. The factor data are calculated from a library maintained by Ahmedabad. So we take that data from there. We use R, and the period is January 2000 to December 2019. So I'll straight away go to the table number 3. How do I divide the firms? So initial firms were 5069 for UCIUL, and then frequency is daily. Method as a standard deviation from the factor model. Criteria is that because we are doing every month regression analysis, we had to have 15 trading data for each company so that we can run the model. Hence, some of the firms were excluded from the sample. So we had finally 4233 samples, which were again divided between BG and SA. So table 2 represents the each year division of firms between BG and SA and how they are distributed throughout the time period. So methodology wise, we use 2 types of methodology. We had portfolio analysis and Palmer-Macbeth regression analysis. So in portfolio, I'll straight away go to the result and show there. Probably that would be. Okay, so very quickly, so on portfolio level analysis, what we do every month, we divide all the stocks under our umbrella into portfolios with quintile portfolios. So top 20 to low 20. So according to UCIUL and CIUL, we divide the companies into portfolios and then find out their characteristics, how the returns are impacting, and their other characteristics also, size, 3-factor alpha, how they are generating, whether depending upon IVOL, if you just group them into portfolios, whether their returns are changing or not. That's your portfolio analysis. This analysis was then verified by Palmer-Macbeth regression. This is 2-way process regression. First, we do a cross-sectional regression for each month for all the sample in our all the firms in our sample. Then do a time series average for the coefficients. That's my regression for equation for Palmer-Macbeth. X represents all the independent variable, including the control variable, which we have just spoken in the other slide. So this is the time series properties of IVL. Because we have gone from EGACH, I had to check for random hypothesis. That for that reason, first we had checked what is the time series, the characteristics or the statistics for my UVIL. If we just concentrate on my autocorrelation levels, we could see that UVIL is not decaying and in the 6th lab also, it's still there remaining, it's not 0. Hence, we could, figure out that we had to use a time series model, which can be used to calculate CIVL, which is the EGACH model. And this kind of criteria is consistent for both my BG and SA. If you can just minimize this, because I don't know the below part is not visible. I think that's fine. So for if you see, for panel B does the work for only BG and panel C does the work for SA, whereas panel A does it for the all data under the umbrella. So kind of autocorrelation lag is persistent, hence we use EGACH. So usage of EGACH is justified from here. We also do a random walk. So we also check in random walk hypothesis testing and found out that mostly 90% all the firms in my sample, more than 95% firms, they do not follow a random walk hypothesis. So hence usage of EGACH was relevant. Now we this is the descriptive statistics for the cross-sectional descriptive statistics. Now the highlighted ones are UCIVL and value of UCIVL and CIVL, both time period consistent and conditional and unconditional. A, B, C is for BGB, for panel B for BG and panel C for SA. So we can see that the value of idiosyncratic volatility highlighted, and there is a difference between BG and SA, which is statistically significant. We see the IVOL is higher for your SA group of firms than your BG group of firms, which is the D statistics is significant, which is mentioned in the box, right? So from first evidence we receive from here that there is a difference in terms of level. let's see what happens in terms of impact. This is the correlation, cross-sectional correlation, this thing, 2 minutes, right? So in cross-sectional correlation, we see there could be a negative hint of negative association between these two factors. This is done separately for UCIBL and CIBL. Then this is the portfolio analysis I was talking about. So again, A, B, C for all firms, BG and SA separately. So if you just sort the portfolio from low to high and just simply do a 5-1 sort of thing and see the return difference, it is clearly visible that there is a negative impact. The negative impact of IUL on Indian stock market persistent for both BG and SA. Now, the level we have seen, it is higher for SA. Let us see, this is for the other one, the conditional one. The results are same, so there is no difference, there is no conflict. So using both the metric. So what is interesting here is, like in US, when you just switch from EGARCH to like from unconditional to conditional, your negative result becomes positive. It just changes. But for Indian market, surprisingly, both the form of measure of idiosyncratic volatility gives us the similar result. So this is persistent. We have done also the time series, time lag, so how it is behaving throughout the years. We have seen that it is decreasing, but the pattern is, in a similar range. It does not contradict to each other, right? So this is the Palmer-Macbeth regression to understand the impact. Now here, if we see the highlighted portion, we could see that finally we understand the impact of IUL on stock return is more prominent in BG group. So earlier we found out the level is higher for SA, but impact is more prominent for BG. So this is a contradicting evidence that we get from here. Now our task is to find out why. So we are trying to divide BG now size-wise and then family-owned BG and non-family-owned BG to find out from where this relationship coming stronger for BG and not for SA. So for standalone firm, the impact is milder, but for business group firms, the impact is more strong. So this is where we stand in terms of hypothesis. We do not reject H1, H2A, and 2B. So we find evidence in support of all the hypotheses. And so that's the contribution that from market to market perspective, this is one parameter by which stocks should be divided because idiosyncrasy does matter. And if it is negative, then clearly there is an investment opportunity. Somebody can fairly earn 1% return every month, which is huge, I guess. So if this exists in market, this is an anomaly. And if it is anomaly, it can only be prevented via more research on it and via arbitrage working. So it is important for the market player, the policy makers, and for the literature. It contributes from the Indian perspective on a whole sum. So that's the contribution. And obviously, we have to update the data. For differentiation between BG and SA, we can also do a dummy variable analysis, which is not done as for now. So that's one. And then, as I said, that BG will be now segregated under several groups to understand why there is such differentiation between level and impact. So that's it from my side. Thank you.
Yeah. Can I come over here? Yeah.
Also, you could do that. We just present it from there.
No, it will be.
PPT.
They will be able to hear my
Yes,
voice.
sir. They'll be able.
Okay. So no problem over there.
You can read it. Yeah. It's already like that. Go to the last one.
Congratulations. It's a very good topic, and it is of very much interest to the market participants as well. And the most important thing is that you have taken a comprehensive data. You have taken almost data for around more than 5,000 companies, and after so much of filtering, around 4,000 companies have been taken up for analysis. And the period of analysis is also very huge, actually, from 2000 to 2019, almost 19 years of data. So the data analysis is the topic is of immense interest to the market, and also the period of the comprehensiveness of the data is also very good, and the period of analysis is also is a very important factor, and it has very come up very well. So these are all not comments, but actually just value additions, you can say. For example, you have said that small standalone firms have high idiosyncratic volatility than big growth-oriented business group firms. So, for example, I can give both at the Indian level and the global level. There are some standalone firms. Take the example of Infosys Limited, actually. So it does not have that much of big group companies, or even, for example, take Apple. They don't have such a big group companies, but still, if you can compare their performance compared to other big business group companies, there are some exceptions to that, so that we have to take into account. Another thing is that the period of analysis is, though it is very comprehensive, it's very long, but during the 19 years time, the markets have witnessed so many bull phases and bear phases. Whether that was taken into consideration or not, I could not find in the research report. Because whether it is a 2000 dot-com bubble, or it's a 2008 financial crisis, or the market fall after the taper tantrum. So these factors, whether it was considered or not, it's not clear in the report. And another is that actually you have mentioned in the report that the enabling factor or the risk mitigating factor for especially for the BG firms is the transfer of resources from the BG firms within the group companies. Now, very recently, SEBI has come up with a lot of reforms in the related party transactions. So tunneling, for example, you need to go for transactions above a certain threshold. You have to go to the shareholders and take approval.
Yes.
So now, given this regulatory, not only in India but elsewhere globally, so there has been a lot of scrutiny on transactions between group firms. So how this is going to probably, if that is implemented in the long term, these results may not hold good in the long term. And another important aspect is that the paper does not suggest any policy formulation. So when you have done a lot of research, but I'm not finding some kind of recommendation. For example, whenever either the stock exchange or SEBI, whenever they say that before investing, just see the fundamentals of the company.
Yes.
So whether this paper has closely, it has almost reached that stage. So what are you recommending? So even just now, you were just saying that actually there is the group, when you were considering all the companies listed in the Indian stock exchange, Indian listed space, there is a negative correlation, correct? So then what does it mean? Whether fundamentals have a strong connection, or fundamentals of the firms have a strong connections with the market returns, or it is otherwise.
Right.
So those kind of suggestions or policy measures could have been suggested in the report that could go long. But otherwise, the report is very good.
Yes.
And it has come up very well.
If I just may answer some of
Yeah,
the
please. You
queries.
can. Yeah.
So when I mean smaller, I'll go point wise, if just 2 minutes. Smaller standalone firms, so when I mean small in terms of market capitalization, so when we talk about Infosys, it's a big standalone firm in terms of size.
Okay.
So there are two aspects. So one is under BG and SA, and another one is size. And size, we mean to say market capitalization. So if we say Google or Infosys, they are big standalone firms. They're not small standalone firms. So they do not come under the exceptions that way. But I do agree that there are smaller standalone firms also, which comes under such exceptions, which you have seen when we go scrutiny firm wise. So we have seen that. So that's well appreciated. We have seen, and that happens, but not with Infosys and Google. Second one is, I probably, for this period of time period, because I was saying this is part of my thesis work, the second part talks about the time trend of idiosyncratic volatility, which caters to what happens during this, incidents. So we see basically the idiosyncratic volatility trend coming down. So when we try to find out, we see that growth opportunities could be one of the reasons for an Indian firm. That idiosyncrasy, or that means the firm-specific information is lagging. That means we do not have firm-specific growth opportunities in the market. So firms are lagging growth opportunities, and hence the idiosyncrasy is decreasing. On the other hand, for US case, this idiosyncrasy is going high because the growth opportunities for smaller companies are more. So there are more information asymmetry. When you have growth opportunities, that means your investors does not know fully that what will happen 10 years down the line. So we have a question on growth opportunities here.
We cannot simply say that, for example, sorry to intervene, but we cannot now simply make assumption that there is a huge information asymmetry because given the for example, the regulatory actions as well as information asymmetry is concerned, because that is a criminal offense.
Yes, yes.
So
no, not insider information. I'm talking about among investors.
okay.
So what I feel about Infosys, my counterpart might feel something else about Infosys.
That is perception, not information.
No, when I say information asymmetry, it's not about only insider trading information. That is absolutely illegal.
Okay.
But so the way I'm searching Google for a report and my friend searching for another report might be different. So she might have access to some other information which is easily available in the net. I'm not saying it is not available.
Okay.
Still there is information asymmetry. So, so that impacts. So that is one thing. And so that has to be taken into account. I just got loose track. So in time period that we have taken into consideration, that probably would be the next paper which we are trying to publish. And on BG and SA, as you were mentioning that, tunneling not share. When we say resource sharing, it is not only transfer of funds from one company to other company to other subsidiaries.
Any kind of resource.
Any kind of resource. So my research and development initiatives can be shared by my group firms. So they have commonalities among them. Hence, the idiosyncrasy is less. Specificness is less because they have more commonalities. Terms of policies they have, terms of ethics they have, the culture they have, the R&D space they are working in. These are all shared. The shared motivation, because the head of the BG is the same. So, the specificness is less. Hence, the idiosyncrasy is less. So that was the argument. Not only the tunneling effect, because that is not. We are not supposed to do tunneling. That's wrong. So transfer of resources.
No, that is not bad actually. Sharing of resources between even financial resources itself is not bad.
Not always. But just to goof off your balance sheet is a bad thing. But then you can always share your resources. That's why you have group companies, right? So we talk about those transfer of resources by this thing. That's why we say that yes.
So we've had lots of discussions. Congratulations, very good paper, very thought-provoking, and clearly, you have worked extensively on this. One quick question is: you said that there were two types of analysis. One, just using econometric methods. You are trying to study the relationship between idiosyncratic volatility and stock returns. And the other explores the economic reasons for whatever you're observing. Is that also part of your research? But it's in a different paper.
It's in a different paper. We have divided into 5 papers. So the reasons are into another 2 different papers.
So what I felt was that you have a 20-year period, 19-year period, and you have more than 4,000 stocks being covered. The underlying economic reasons would have changed over time, because India as a market has matured and changed in very significant ways. In fact, you were talking about information asymmetry. You can see different regimes. There was a time when it was a very leaky market to now when the information asymmetries are much less. So when you do I don't have the ability to understand all the methodologies that you have used, but when you are doing this analysis over such a long period, over such a wide variety of companies, does it still hold good, the results that you are producing, or should it be,
So to do that, what we do is, so there is 2 things. One is a cross-sectional analysis and one is a time phase analysis. So what in my case is, for the last part, what we did a cross-sectional which comprises all. But for time specific, you are saying I am divided from 2000 to 2019 into 3 years bucket and analyze the impact of those determinants of IVOL separately for these 3 buckets. So to see whether these impacts are only for the entire impact, or it is lagging, phasing out, or it is still persistent. So in many cases, for many factors, we have seen that it has phased out. Like for your earnings management was one of the reasons, which has phased out significantly. On the other hand, product market competition between the market is increasing. The impact is increasing because there are more and more companies for a specific industry, right? So that is increasing, and then your earnings management impact is phasing out. So that we have done, we have analyzed.
So the other question, the only other question, I think we have to move to the next one, was this your choice of business group versus standalone? Has this kind of analysis being done anywhere else in your literature survey? Has it? Nobody has done it. So this is but in other places, what is the segmentation that they have
They
done?
do basically industry-wise or size-wise. They have, to my best of my knowledge, I would try to say that I have not found out a paper talking about DG and SS separately and family-owned, non-family-owned separately. We take it for Indian groups mostly because India is, when I see 95% of my firms, she was presenting, if I just say 20% ownership and just categorize it as family and non-family, 95% of my firms falls under, family firms. So that kind of skewness I have in terms of ownership structure. So if I don't consider these, so probably.
I think we are out of time. So thank you so much. Wonderful paper, very good presentation. Thank you.
Thank you.
I'd like to request Chandrika Raghavendra to present her paper on does CO2 emissions impact cross-border mergers and acquisition decisions. Over to you.
Thank you. So good evening, everybody. I'm Chandrika. I'm pursuing my PhD at Amrita Vishwavidyapeetham, and I'm in the 4th year of my research. And I am basically investigating how sustainable development practices of the home country is impacting the CBA activities in India. One of my objective is how CO2 emissions are impacting. So in this context, we developed the paper on how CO2 emissions are having an impact on the CBA activities. We have taken the evidence from Indian market. I'll be presenting today on how we have got the research idea, what are the research questions that we had in our mind, and then how did we develop a hypothesis, where did we collect the data and the methodology that we adopted, and what results talk, and the conclusive remarks. So basically, as we all know that India is the fastest growing emerging economy, which is the third most attractive destinations for MNEs, whether it be CBA through the route of CBA, that is the cross-border acquisitions, or through greenfield investments, which are the form of FDI. The point is that we all are moving towards a sustainable development. When we talk about the sustainable development, the major concern for us is the global warming, which is one of the global warming, climate change, and the emissions. These are very top, and we all are towards, as in the morning also during the sessions that we were talking, we all are towards the net zero emission. And when we have all these, the talk of the town today, we need to understand whether India is becoming a pollution heaven for the MNEs. Is that the hidden reason why the MNEs are trying to enter through CBA and the FDI route to Indian market? This was the initial doubt that we had in our mind. And when we looked at the statistics recently, we got to know recent statistics shows that the emission rating of the emerged economies are decreasing while the emerging economies emissions are increasing. This is true also, this basically from the EKC theory, which says and proves, again disproved by various other authors time to time, but still the argument is that there is an inverted U-shaped relationship between the growth of the country measured in terms of the income level and the emission rate, which can be measured for, taken a proxy for the environmental degradation. So if that is so, as a growing country, we would be emitting more in the initial stages, and as and when we become wealthier, across the globe it is. So as and when we are becoming wealthier, we understand that the environment protection is important, and technological advancement happens, and that is how, because of the stricter rules and regulations, the companies are trying to mitigate the carbon risk that is prevailing in their country. When they're trying to mitigate, are they migrating it? Is the next question that we got. So when we looked at another theory of pollution heaven hypothesis, which talks that, which very clearly says that the emerged economies who are able to or trying to control the emissions are looking for such emerging economies where the CO2 emission is not a concern, major concern, where the growth is a major concern. And there is a regulatory weakness in the system so that it is easy for them to migrate. So this is the argument given by the pollution heaven hypothesis. In this background, we also looked at is Indian regulatory system so weak? Because that was the next obvious question in our mind if we are thinking of India becoming a dumping zone, carbon dumping zone. So Indian regulation system, with respect to environmental regulation system I'm talking about, it all started way back in 1980s, but then it was not that intensive. But after 2000, we could see a lot of year on year improvising the regulatory policies and programs, and I would say the government is trying its best to strengthen the regulatory aspects in Indian context. In this background, we got few research questions in our mind, whether the home country CO2 emission is having any impact on the CBA decisions involving the volume, number of CBA activities that the MNEs undertake in India, and the stake acquisitions, the percentage of equity that they seek with the Indian targets. These were our major questions. And since the pollution heaven hypothesis argues that supporting evidences are also there that the companies try to identify emerging economies to target for CBA activities where there is an institutional weakness. One of the very big institutional weakness that we have is the corruption. So which is never under control, which the evidences talks about. So we decided to see whether corruption of India is playing any kind of moderating role in this context. So these were the research questions that we had in our mind, and we did an extensive literature review on how the EKC theory is being proved, disproved, and various other formation of the relationship between the a country's level of income and the environmental degradation is talked about. And then we did pollution heaven hypothesis also, little literature review extensively on that as well. And then we understood what are the factors which influence the CO2 emission. And then we continued. Our major concern was what is the relationship between the FDI and the CO2 emission, because there is no much research done on CBA, especially from Indian context, because of its own risk factors that are available, because data is the major issue here in India. So there are no much research done. Even if that is the case, so we had to rely on FDI. CBA is, as UNCTAD has been quoting that in every few of its reports, I cannot say every, I'm sorry, a few of its reports mention that around 70 to 80% of the FDI flow is through CBA activities across the globe. So we can rely that CBA activities is a major component in the FDI. So we try to understand what is the relationship between FDI and the CO2 emission. So we could understand that there is a controversial, again, findings on the two. First thing is that it negatively impacts because the FDI flows, then country growth because of the industrialization, a lot of importance given, and that is how the emission also increases. So it has a negative impact. On the positive side, there would be transfer of technology, managerial capability, learning curve effect. That is how this spillover, effect can be seen on the host countries, so that the positive impact can be seen on the CO2 emission. So this is what we found. And then interestingly and more surprisingly, there is no knowledge to us till date how CO2 emissions are impacting CBA activities. But we could find two major papers recently that were not published through the publication. It is in the press. It is not yet published, but it is available. We could access to one of the papers, which is in Finance, Journal of Finance. The other one is published in 2016, but they are not talking again on CBA decisions. They are talking about one is talking about the CBA likelihood and how does the CO2 emissions impact the CBA likelihood. They are talking about. The other one is talking about how does it impact the performance of the acquirer. So in this context, when we looked at the decisions, the findings are quite interesting. The first finding supports that the CBA, the likelihood of CBA activities in such host countries are higher when there is an institutional weakness. And the other paper says that if the host country's CBA CO2 emission is higher, that gives a positive return to the acquirers. But it is for a short-term period, and in the longer run, it evades. That is what is the findings that the literature review gave us on CBA with respect to CO2 emission. And we also looked at what are the different factors that CBA gets impacted, CBA activities or decisions get impacted. And we could find a lot of variables, including country macroeconomic variables. We found the institutional factors, the cultural factors, and the list is very big and everlasting. It is still, I myself have done around 2,600 literature reviews, and I have submitted an SLR also. And still we are feeling that every day a lot of the other papers are coming and new variables are coming. So it is very, very, I can say it's an ocean. So in this context, when we did a whole literature review, we could understand there is a huge gap in the literature to provide us the evidence on how CO2 emissions are impacting the CBA activities. So we developed a hypothesis based on this. The motivation was that the whole world is towards the net zero emission. So that was a major motivation for us to look for how these factors are impacting on the CBA activity. That is how we started it. And then the hypothesis that we developed was the first hypothesis. We argue that the CO2 emission of the home country is negatively related to the volume and the number. Why do we think so? Is because I agree that India has weakness with respect to regulatory aspects. I am not talking about, the researchers talking about. They have provided us the evidence on that. But yet, India is putting a lot of efforts to improvise the institutional framework. Indian environmentalists, economists, policymakers are not so naive to allow any company to enter India and make it a pollution heaven for them. It is not so easy. India is not so naive. That is what I personally argued. And that is how we started building, whether it's true, we started digging the literatures, and then we could find a link. We thought that yes, this could be a possibility, and we wish it is true. This was how we started, and that is how we argued that the CO2 emission, because and we also understood that high emitting, if the host country has a high emission, then acquirers gain only in the short run. In long run, they get their profitability and their wealth gets affected. This could be a major breakthrough for us to understand that the CO2 emission has an impact, but how is the impact? We don't know, because there is no background research on this. So as to continue with that, how does it impact on the percentage stake acquisition? We from the existing literature, we know that whenever there are a lot of regulatory changes in the system, it creates uncertainty in the market, in the economy. When there is a regulatory related uncertainty, we found that the MNEs prefer the full stake. So especially the high emitting countries would prefer the full stake acquisition because they are scared of the changing policies and programs. They would be having information asymmetry, that they will not know properly what type of programs and policies the India would be changing in the near future and how to tackle it, because the high emitting countries are trying to mitigate it. So that is the reason, that is the argument that we got, that they would try to take the full acquisition. If so, if this has been proved, then we have all the chances that India is a pollution heaven for the high emitting countries who are entering into India through full stake acquisition. There is a threat for us through this. And we started analyzing how we also brought in the moderating effect of the corruption. Corruption, we know that is having a negative impact on a lot of economic activity. But so far with the CBA activities, we have found out that if the host country has the corruption, then the CBA acquirers gain. So this is what is the findings from the literature we get to see, because it is easy for them to tackle any situations through bribing. But on the other hand, there is another there are other findings also which argues that it becomes costlier for them as they have to, CBA activities becomes costlier for them as they have to pay additionally to bribe the bureaucrats and the other related policy related regulatory people. So that is how there is a two-sided argument on that. We wanted to see whether it is going to intensify the relationship of the CO2 emission and the CBA decisions. So we have assumed that it is going to be intensifying the relationship. Data is sourced from the Econ software, the Thomson Reuters Econ from the year 1990 to 2020. We have gathered the data from around 47 home countries. The acquiring firms are from 47 home countries, and totally around 979 net observations we found for testing the volume and number. And for testing the stake acquisition, we got around the net sample size of D level data, which is around 3,867 from the gross of around 1,597 to 5,642 respectively. And our dependent variables are CBA volume, number, and ownership stake. And value and number is the aggregate value and the number between two countries, that is India as a host and the acquiring country, during a particular period of time, particular year. We have taken it as a year. So we have made it a country per year observation. So that is how we have taken, following the authors who have done the similar study, but using a different independent variables. And the major independent variables are CO2 emission and the control of corruption. And we have taken a interacting effect of the two. And we also have got some control variables in our study, which is based on the existing theory of knowledge on CBA activities, because the dependent variables of here, CBA, determinants of CBA, we have to see what impacts the CBA. So we have brought them as a control variables. And this is how we develop the model. The volume, is with the, I would just run through because I've got only 2 minutes of time. So we have used the Tobit regression model for the volume because it's censored. So to address the censoring bias, we have used the Tobit regression model, and the number is a count data. So we have used the negative binomial regression model. And for the last one, we have taken the variable as 100% stake and the below 100%. 100% would be a full stake acquisition, which will go with a value of 1. And anything lesser than 100, we have considered that as a partial acquisition, and that goes with a value of 0. So we have applied, because it's a binary data, we have applied a logic regression model. We have also used year dummies and acquiring country dummies to capture the year time related shocks and acquire specific invariable shocks. And we have used lagged values by all the independent variables, for all the independent variables, lagged values of 1 year, to avoid any possible endogeneity issue with the dependent variables. And we have checked for multicollinearity through VIF as well as through the correlation matrix, and we did not find any multicollinearity and among the variables that we have used in the model. And we have done the robustness check also with multiple specifications in the model, and we got the similar results. And I'll just skip through, if you don't mind, the descriptive statistics correlation table. And this is the result. We found that with the Tobit regression model, the volume is negatively related with the CO2 emission of the home country. When the home country CO2 emission is lesser, there is a there is 6.7% increase in the volume in India. So we are attracting less emitting country. This is a positive note. So less emitting countries are the one who are advanced countries, developed, and the further study can be done whether there is a spillover effect on technology transfer, managerial ability transfer. That is how we can make sure that there is no migration of the CO2 emission. And the moderating effect is also been proved, intensifying the relationship. So with the existence of corruption, the less emitting countries are investing more because it becomes easier for them to manage and gain through the CBA activities. Similar results we found on through the negative binomial regression model also on numbers, but it is not statistically significant even though the coefficients are negative. So our hypothesis was not supported. And on logic regression model, we found that the high emitting countries are taking the full stake acquisition, which was our concern before. We didn't wanted this. We wanted a negative impact. but we found a positive impact. So the less emitting countries are entering India with high volume and more number of CBA activities. But the threat is that the less emitting countries are investing through high amount of volume and more number of CBA activity. But the threat is that the high amount of emission, the countries who are emitting high amount of CO2 are entering through the full stake acquisition. Full stake acquisition means they will have complete control over the company's operations in India. And as per the pollution haven hypothesis, it can be true that they are producing unfriendly products here and then exporting from India to their country, and that is how India is becoming a dumping zone again. So there is always a threat, and we suggest the policymakers to have a close eye on the full stake acquirers who are targeting Indian companies through full stake acquisitions, because they are the major culprits here who can possibly make Indian all efforts go in vain of strengthening the environmental related aspects. So we suggest the policymakers to have a close eye on them, economists, researchers to have a close eye on them, their performance, their operations, and their emission level, because emission is becoming mandatory and they have to show it. So we request or suggest that it has to be made mandatory very soon, so that we can have a close look on them. And controlling of corruption is needed, so that the high emitting countries taking advantage on Indian weakness of institution should not be a case wherein India becomes a more extensively a dumping zone. So this is what is we suggest, and further research can be taken with the micro level emission, with the company level emission data can be extensively matched with the CBA decisions. And a lot of other areas are there, which we have, I would have definitely spoken about, but I think, due to the time limit, I don't want others to wait. I'm really sorry, I've taken some time extra. And I think personally that it's not, government responsibility all alone. I just reminded of, if you don't mind, just few seconds, I just reminded of a situation just now that I was talking to my daughter a few days before, and she said, should we stop breathing? I asked why. Why are you talking? She was creating some project on the global warming. And she said, we are, when we exhale, we are exhaling the carbon emission. And ma'am said at school that we should not emit the carbon. So, and she said, is there any kind of technology which we can bring it to our lungs so that we can, exhale only good air and not that. And I was astonished to think that a 9-year-old child can think about it. Why can't we all think? Every step matters. Let's have an eye open on our environment so that we are towards the sustainable goal. Thank you.
I request Krishnamoorthy to present his remarks.
Congratulations, Chandrika. It's a good report, and you have built the concept backed by good literature review, and also by hypothesis. And the data has been very robust, and it is also backed up by the alternate methodology. That also you have done it. And again, comprehensive data has been taken comprehensively, and you have taken a large number of data for analysis, especially 47 home countries data. So I just would like to share my thoughts. They are not comments, but actually thoughts for improving these, the report, to strengthen the report further. Maybe probably you would have taken the data on a macro level. For example, I will just give an example. Tomorrow, if a foreign company is coming here and is taking, acquiring a company situated in Bangalore. Okay, so but more number of deals may be happening in Bangalore, in Mumbai, but when you are calculating the CO2 emissions, you'll be taking the data at a macro level all over the India, correct? No, you will not be taking city-wise.
It's a country data.
It's a country data. So probably then how are we going to link that? Am I right? I am making my investments in, for example, let us see, I have got $15 billion of investments. Most of my projects are done, not in Delhi, okay, because let us see, Delhi has a lot of the high level of pollution in India, but I have made my investments in Chennai, in Coimbatore, or in Bangalore, or in Hyderabad. But how are you relating these two data, my CBA versus my CO2 emission?
So to answer this question, we are not considering the CBA activities or the CO2 emission on the firm level.
Okay.
We have taken both the variables at the country level.
Country level only I am saying, not at the firm level. Country level only. You will, for example, that's why I gave the example. You have taken the data for what is the number of cross CBA in a particular year at the country level, and at the same time, what is the CO2 emission at the country level, correct?
Correct.
My understanding
Yes,
is right.
yes.
So now, if you just dissect further, so the CBA happened at some other place, but some other destination will emit more carbon emissions, correct? Do you have the understanding my point? So these levels. So that is one point. Now going to the next point. CO2 emissions need not necessarily by manufacturing companies. There have been the entire Delhi was under no cloud because of agricultural activities, correct? So in those situations, what are we trying to say? Fine. So, and coming to your point of corruption, actually, corruption is a global phenomenon. It's a global disease like COVID. It is not only there in India, but elsewhere. Even globally, multinational companies, they have been accused of entering into corruption. Politicians, elections of presidents, Mr. Donald Trump. Right?
Classic example.
So it was, so we're influenced by corruption, actually. I'm not saying that it is true or it is false, but there were news reports, there were debates, discussions about this. So corruption is a global phenomenon. We cannot say that actually only it is there in only in emerging markets, not there in developed markets. So it is there in everywhere, and every country is trying to reduce that. But linking this with CBA emissions, and again coming to a conclusion that since MNEs, multinational enterprises, are finding it easy targets at emerging market levels because they feel that the institutions are weak. So therefore, the level of corruption can be done much easily. So this kind of logics does not hold water. So probably the approach to the paper is very nice, but probably you can think of the linkages. I'm just seeing from the practical perspective, probably may look into this as well. Yeah.
Thanks a lot, sir.
Thank you.
So, companies invest for various reasons. Like say a foreign insurance company investing in doing a cross-border acquisition of an Indian insurance company is doing it for its India business because the consumer is in India, the market is in India. They're not doing it because they're manufacturing something here that can be exported. So your pollution haven argument applies to certain set of companies, but it doesn't apply to certain other set of companies. So when you're looking at your data, have you distinguished between the type of company?
That is what the next phase we are working on.
Okay.
We haven't, this was our first objective to start with. And that is how we have developed how variables energy consumption and other environmental regulation policies are impacting, and then how is it different from sector wise. That is what we are planning.
Yeah, because your preoccupation is with a country becoming a pollution haven, but what you're measuring in terms of the carbon intensity and so on is a big macro variable, which is being affected by so many different factors. So that is what concerned me when I was looking at your paper. And it started with the title, Do CO2 emissions impact cross-border M&As? I said, intuitively, it doesn't look to me that both the two are related, right? Yeah. But as you started talking about, I understood what your motivation is. But still, I think the paper needs to focus better on what you're trying to solve and then ask the right questions. You've done a lot of work on the in terms of collecting the data and the methodology, and so which may still be useful. But my first reaction is that the framing of the problem has to be addressed.
This was, as I said, this was the first beginning phase of my research, and now we have almost altered a lot, and that has taken a new shape.
Yeah,
now.
but I must say that this is an important question that you are asking, and this whole transition is going to be a very important research area, and you need to understand it at multiple levels. So you're in the right place. You're in interrogating the right stuff, but you need to sharpen your research and analysis.
I would need, that was the major reason why I personally came, so that I can take down the suggestions that you're giving.
And then we can talk more. I mean, right now we don't have time, so let's move on.
Good reports probably you can do at micro instead of doing at macro. Maybe you can do it micro, maybe that may throw some concerns.
Just a question, Amrita, that Kuznets theory, what you were talking about, that emissions are inversely proportional to income. Yeah, like less income countries are emitting, more. That's what. But when you see the practical report,
Less income countries, I mean developing countries.
yeah, developing. But when you see the report, it's like US and China are topping the emissions index. Like mostly all the reports show that. So
No, emissions are higher in emerging economies, not in the developed
So
economies.
that's directly proportional.
Yes. And there are theories which does not support
I think we should move on.
efficacy hypothesis.
I think
Let's-
we one off. I think
Yeah.
because it's an endless kind of topic.
Yes.
Nobody's right, nobody's wrong.
So now,
It's debatable. It's debatable.
now we move on to the last
Sorry,
paper,
but for the next question.
last paper for the day, which will be presented by Sohil, PC and Nilesh. The paper is titled The Impact of Mandatory CSR on Firm Financial and Sustainability Performances, Evidence from India. So I would request them to take over, and they are joining us online. So if you could please share your screen. Nidish is there with us. Yeah, Nidish, if you could just share your screen. Nidish, can you hear us?
Make sure whether they are hearing us.
No, they are.
Yeah, any connectivity issue. Nothing. Maybe for a few seconds or so.
They are not here, neither Suhail PC nor Siddesh.
Yes, actually, they were, I'll just call them. Just 2 minutes. I don't think Nidesh
It's a no-show.
is ready. So I think we'll just conclude the session.
Yeah,
then.
sure.
Right? Okay, so I just, yeah.
Benefit of doubt.
Yeah. Just check with them once again if it is there, otherwise we
We've
can.
been checking with them for
But
that.
at least they could have communicated it.
Absolutely.
So on a moral ground, they could have communicated, right?
We have been asking them from lot of time.
Needs to understand others' time as well.
the volunteers organizing, the presenters for a wonderful job of presenting, and the discussant.
So good evening, ladies and gentlemen. It has been an honor to be a part of this wonderful event. On behalf of NISM and SEBI, I'd like to extend my heartfelt gratitude to our esteemed paper presenters, chairs, discussants, and all participants. I'd also like to extend my sincere thanks to all attendees and participants, both online and offline, for making the time to be with us and helping us make this event a grand success. I request Jitendra Kumar sir to present the token of appreciation to our Honorable Chair Vidhu Shekar sir and Discussant M Krishnamoorthy sir.
Yeah, sure, yes, yeah, this. Thank you, sir.
So this marks the end of day